Markets up, Chuck. And today's blog was talking about volatility is not risk. I pointed out that we've had a nice, rally in the stock market here recently, and everyone's now getting freaked out. And then today, actually, the market's down, which, there has to be a correction when you've had stock prices rise as much as they have for as long as they have, but that's just what the normal volatility is. But the point I tried to make is, in the blog, is that when you know what a company is worth, you can make sound decisions. So this is actually an ADR. This is an Indian bank, but I chose the picture because the picture tells a story, in my opinion. I want you to notice this company has had very strong earnings growth, right even through all the recessions. They have no debt on the balance sheet. Their earnings have grown at 24.5%. But the black line here is the stock price line. And look at when the price was below its earnings justified level, it always rose back to its justified level and usually above. Here was a period here from February of 07 where it got really massively overvalued, and then the stock, proceeded for the next 2 years or so to fall dramatically to where it got undervalued, and then we've had this very strong recovery recently. And the point is, when if you believe, as I do, that this blue line represents the value of the company, when the stock price of any company gets disconnected from that line, you can make intelligent decisions, which was the point of the blog. The second example is United Technologies, a very well-known conglomerate, Otis Elevators, Sikorsky Helicopters, Carrier Air Conditioning, etc. But I want you to notice again, very strong earnings growth. We did have a recession. The stock was overvalued prior to coming into the recession. The market took the stock price significantly down, but I would argue this is a $59 stock that had fallen to $43, and because I trusted that value, I was willing to buy that stock here, not sell it, or I would be willing to buy the stock, because if I look back historically, every time the price got above earnings, it always came back, and every time it got below earnings, it always came back. So as long as I knew what the value of the stock was, whatever the market was doing wouldn't affect me. Now, it could cause me to sell if I bought it, here and owned it here, because that means that I'd be selling an overvalued stock, and I'd be waiting until it came back into this line, and, would be patient enough to buy it back again. But as long as I knew what my company was worth, I don't let the volatility of stock prices bother me. So my last example today is going to be Buffalo Wild Wings. And again, I'm showing this because here's a company, it's a very fast-growing restaurant chain. I want you to notice the earnings growth has been very, very strong. It's a small-cap company, has no debt in the balance sheet. But again, as long as you were trusting that these earnings were there, when it got overpriced, you could have sold. When it got underpriced, these were great times to buy the stock as a long-term investor, because inevitably the price is always going to come back to its earnings justified level. So the whole point of the blog was, if you know what you own is worth, especially if it's a common, publicly traded common stock, then the market can never cause you to do things you shouldn't do. You can buy when it's cheap, you can sell when it's expensive, and always be making rational decisions rather than emotional ones. This is Chuck Arnold saying thanks for listening. I'll talk to you again tomorrow.